purpose of this presentation is to explain the value and potential benefits of understanding and using contribution margin. It is intended to be a useful introduction to those considering or already operating a small or medium-sized business, including franchisees and those supporting those businesses such as franchisors. This is an introduction only and is not intended to replace qualified accounting and financial advice. All viewers should complete their own research and investigation before taking any action based on this presentation. The opinions expressed throughout this presentation are those of the presenter, and while well researched and gained through decades of industry experience, they do not necessarily represent the opinions of FMS Support Services. Unless specifically mentioned, no assumptions should be made about the identity of any individuals, franchisees, or franchisors referenced in this presentation. Hello again, this is Sean Butcher from FMS Support Services. We are focused on assisting franchisors, franchisees, and all manner of small, medium, and large businesses, especially those dealing with the complexities of operating multiple sites. We provide a full suite of diverse support services. Throughout the last 30 years, I've been consistently involved in franchising in some format or another. I've worked on both sides of the fence as a franchisee and franchisor. I have owned or part-owned 16 of my own franchises plus one franchisor and consistently worked as an executive and or a consultant to many of Australia's up-and-coming franchisors as well as industry leaders. However, my passion has definitely been working with those that are struggling and need an urgent turnaround, or those up-and-comers that are wanting to grow. This is part of a series of presentations in an effort to address many of the most common questions, concerns, and topics that I am asked frequently about. I'll speak as honestly as I can and provide as much genuine insight as I can, without sugarcoating anything. If that offends people, then please cease viewing or listening. I'm no technical genius, and I am aware that my voice sounds something like Oscar the Grouch with a cold, so no need to critique that. I'm well aware of it already. This presentation, more so than most others, is definitely best with video content through somewhere like YouTube or Spotify, but is also suitable for listening as an audio podcast for those who like to take in something while driving or jogging or doing whatever they like. The reason for this is that there is a bit of basic maths included in this presentation, which is a lot easier to understand when you can see the formulas and the examples. However, I will attempt to work my way through the presentation in a way that it can be beneficial for both viewing and listening without trying to confuse either audience. But if you are confused, please definitely review the video format for more clarity. Just as a quick FYI, the reason this presentation is called The Magic of Contribution Margin is because so many times when I've sat down and taken business owners and managers through this, the look on their face is like I performed some kind of magic trick. Not so long ago, I actually sat in a room with a CEO from a fairly large restaurant franchisor and three senior executives who bemoaned the fact that they had been trying to convince franchisees that they were making money when selling meals on third-party aggregators like Uber Eats and DoorDash, although they obviously hadn't actually provided any figures to franchisees to support this or even done the calculations themselves. And on the other side, there was, of course, the franchisees who simply assumed they were losing money because a large chunk of their income from each of these orders went to the third-party aggregators. Therefore, they must be losing money. So essentially, franchisees and franchisor were arguing, but nobody was doing the maths. And the third-party aggregator orders made up as much as 80% of sales for some of these network franchisees. So it was an important thing for everybody to understand. I suggested using contribution margin to work through this with franchisees. The CEO and two of the executives had no idea what I was talking about. One of the executives, who happened to be the CFO, did obviously know about contribution margin, but was unfortunately generally left out of such conversations regarding the franchisees, so had never put this forward as an idea. The franchisor had been operating for decades without ever really doing the maths. Anyway, long story short, I provided a bunch of information, articles, and presentations I'd done on the topic to the CFO, and he presented this at the next series of roadshow presentations to franchisees as the keynote presentation to completely change their understanding of how the model worked. At the same time, this also enabled the network to start accurately calculating break evens for their franchisees instead of guessing, which is what they had historically done. All of that from a simple mathematical formula that, in my experience, is not even considered by franchisors 50% of the time, or applied incorrectly a further 10% of the time. So, with that said, let's start by covering a bit about contribution margin, as it is important not just in franchising, but in a majority of businesses in general. Okay, this I'm calling bad maths in action. For those viewing the screen, here is some classic bad maths. This is commonly trotted out, dressed as advice to explain why businesses are not making money or need to sell their products for extremely high prices or even avoid providing some services and products just to break even, which then unfortunately causes these businesses to be worse off. Now, don't get me wrong, I want to sell any product or service from a business I am involved with for as much as possible too. However, volume is also a necessity in order to maximize profits, and not surprisingly, the higher the price, the less volume, or the less products or services are going to be sold, with only very few exceptions. Firstly, where there is a 100% captured market and the product being sold is an essential commodity. Maybe, for example, you have the catering rights to a hospital, prison, mining village, or school. People in these situations have basically nowhere else to go and they have to eat. Secondly, where there is simply no competition, I'm thinking of something like the only petrol station in a regional town. Where else could people go? Obviously, they couldn't run their cars and machinery without petrol, so customers are going to have to purchase from that single petrol station. Thirdly, is where demand already exceeds supply, and you can afford to lose some customers, and others will simply take their place. In Australia, the childcare industry is a really good example of this. It's a sector that I can tell you from first-hand experience where even the worst childcare centres are basically at capacity because parents are desperate to get their kids in anywhere so they can afford to work and afford to live. However, in all other situations, finding that point where the volume of products, services, or customers meets the best possible price for maximum profitability is essential, and that requires getting the maths right. Now, for those watching the screen, there is a diagram from the Pittsburgh Post-Gazette which tries to highlight why restaurants supposedly lose money by selling food on third-party aggregator sites such as Uber Eats and DoorDash. Now, I've got another presentation coming up on how to maximize earning potential on third-party aggregators shortly, so I won't go into that now. However, this time, let's just look at the flawed maths, which in this case may lead restaurants to reach the conclusion that they will actually lose money if they sell products on third-party aggregators due to the fees that the third-party aggregators charge. Now, for those who can't see the screen, the diagram from the Pittsburgh Post-Gazette breaks down the cost of a meal being sold on third-party aggregators as follows. It says 25 to 28% of the sales from the order go towards COGS, or cost of goods sold, or food costs. This is the ingredients and the packaging. This is probably on the low side of average by the Australian standard, but definitely also realistic. Then they've said that 30% of sales from the order will go towards labour, which is staff wages, salaries, superannuation, and associated costs like that. Then they have added 30% for fixed costs, which includes things like rent, electricity, gas, insurances, and other costs which are fixed, basically meaning that they don't change in relation to sales volume. Then they have added 25 to 30% for third-party delivery fees, which is the cost of paying the third-party aggregators such as Uber Eats or DoorDash to provide their service. In some cases, this can actually be as high as 33% in the Australian market. although higher volume restaurants and franchises are generally paying less. Now, for anyone keeping track or just looking at the picture, what the Pittsburgh Post-Gazette then concludes is that a restaurant will have expenses of between 110% and 118% from each sale. What they are saying is that for every $100 of orders sold through third-party aggregators, for nice round figures, the Pittsburgh Gazette concludes that the restaurant incurs between $110 and $118 of expenses. Not surprisingly, they also conclude that restaurants therefore shouldn't be selling meals on third-party aggregators. Or, to give a bit more of a realistic customer sale example using the same sort of flawed maths, here's a common example from food service, once again explaining why they lose money on third-party aggregators such as Uber Eats and DoorDash. This example sets out a sale of $33. And for those that can see it on the screen, that makes it a lot easier. For those that can't, I'll try and explain it. Firstly, it says if the order costs the customer $33, then we need to deduct 10% extra that was added to the net cost for GST. Now, that's an Australian thing, although, of course, many other countries also have GST or consumption tax of some description. Alternatively, if you don't have consumption tax or a GST in your country, then forget about that part. Likewise, as well as a revenue or sales, all expenses should also be net, which means we exclude the GST or the consumption tax, as this is always calculated separately, both when GST is paid as well as when it is received. So hopefully that makes sense to everybody. It can take a fair bit of time to get their head around that. But in simple terms, remove GST from your sales revenue and remove GST from your expenses before doing any calculations. Now, then in this example, we also, once again, deduct 30% or $9 for third-party aggregator costs. They've deducted 30% or $9 for cost of goods sold, which is once again food costs. They've deducted 10% or $3 for franchise and marketing fees, assuming that this restaurant is part of a franchise. Then there's another 30% or $9 deducted for labor costs. That's wages, salaries, superannuation. Another 10% for $3 for rent. And another 10% or $3 for other overheads. Then we reach a conclusion based on this bad maths that we just lost $6 or 20% on this order. So now let's go a bit further and let's correct some of this maths. The most important thing to remember is that only the costs related to the order should be considered, not costs that will still need to be paid even if there is no order. All right, so let's break down the previous example again. Now, up on the screen, for those watching, you will see that that table from the previous slide has once again been put up. The sales and the GST deduction are still 100% correct. The third-party aggregator, COGS, franchise and marketing fees are also correct because you will directly incur these expenses with every order. You cannot avoid them. They may fluctuate slightly, but you absolutely will incur third-party aggregator, COGS, franchise and marketing expenses with every single order of this type that you receive. However, the other expenses that were listed should not be included. This is because they're going to be incurred regardless of whether you have any orders or not. These have been crossed out on the screen for those watching and also put in a big yellow box at the side. But this includes labor. Now, too often, labor is treated as a variable expense. However, particularly in a lower volume operation, it is really a fixed cost. Now, think about this. Say you need a minimum of 2 people to operate a small restaurant. one for front of house, serving customers, clearing tables, operating the bar, etc., and one for the back of house or kitchen to prepare the food. You will still be paying for these two staff regardless of if there is 0 orders, 1, 5, 10, 12, or maybe even more per hour. Now, obviously, as the volume increases to much higher levels in larger restaurants, additional staff will slowly need to be added. But the extra amount per order that is variable is quite negligible and definitely not 30% of an order cost in a restaurant, especially in a lower volume restaurant. Likewise, there's rent. The landlord is not going to take 10% or any other percentage of your order in the majority of cases. They are going to charge you a fixed amount of rent, regardless of whether you do $0 in sales per week or $100,000 in sales per week. Now, there are some exceptions to this, where a smaller percentage of landlords may charge what is commonly called percentage rent for higher profile and high volume tenants. Usually this is above a certain minimum sales threshold, but this is not a consideration for the majority of businesses. Likewise, other overheads. The reality is your overheads like insurance still need to be paid regardless of your sales. You will still use almost exactly the same amount of electricity regardless of whether you have customers or not, because you will still need to turn the lights on, you turn your equipment on, you'll keep your fridges and your freezers turned on, and turn on all your powered computers and tech devices at the same time every day. Likewise, with the majority of gas-powered equipment, and you will still need to pay for all the same software and licenses, and the same thing with other overheads, which is why these are commonly called fixed costs, because they are fixed regardless of your sales volume. They are not increasing in any significant way because of any order or customer. So we have eliminated those costs that are going to be incurred regardless of the order. In this case, that was labor, rent, and other overheads. And now all of a sudden the order is showing a profit of 30% or $9. Now, this isn't technically a profit from an accounting perspective, although on the screen we've stuck with the terminology from the Pittsburgh Post-Gazette. This is actually what we call the contribution margin. With this in mind, the definition of a contribution margin is contribution margin is the amount that is left from sales revenue after variable costs or expenses are deducted. This is then used to cover fixed costs or is the profit of the business. It can be calculated based on any individual sale or the business sales revenue as a whole. So why is contribution margin so important? Firstly, contribution margin is the simplest and most versatile formula for understanding how profitability works in business from an individual product or service level through to the business as a whole. As per the earlier examples, by utilizing contribution margin to analyze the individual product sales that were believed, based on very poor maths, to be losing money and bad for the business, we then saw that they are actually beneficial for the business. In simple terms, any sale with a positive contribution margin is helping to cover fixed costs or profit, and therefore it's beneficial to the business. It, at the very least, covers its own cost. Next. Contribution margin enables profitability to be accurately estimated and projected at any volume, and break even to be accurately calculated. Now, this is essential for business to understand, but concerningly, the majority of businesses have not accurately worked this out. Even in supposedly large and successful franchise networks, Now, as I mentioned at the start, one reasonably large franchise I was involved with had not accurately worked out break even on any site in their entire network. Even worse, the franchisor just made up some ballpark break evens that they thought applied. Even more concerningly, the break evens they worked out for their franchisees were understating their break even by thousands of dollars per week. In most cases, this was around $3,000 to $4,000. Now, this had led to a lot of tension between the franchisor, who insisted all their franchisees were making a lot of money, and franchisees who were insisting they were losing money. It turns out the franchisees were mostly correct. Once we went through the process of actually working out break-evens for the franchisees, we at least knew that franchisees had to be aiming for a sales level which was generally much higher than what they were told to aim for previously. We also were able to utilize the same information to accurately work out the sales level required to reach levels of profitability that the franchisees were going to be happy with. Sadly, the franchisor in this case, while embracing the calculation of contribution margin on orders, deals, and promotions moving forward, preferred to keep its head in the sand on break-evens, as they knew a very significant portion of franchisees were now falling short of break-even, and they preferred their imaginary numbers instead. A very sad example of a very poor quality franchisor. Anyway, now let's work through some of the actual process involved in working out contribution margin and using it effectively and beneficially to its full potential. The first thing we need to understand to do this is classifying fixed and variable costs. Now, these are costs or expenses, as they're commonly called. They can be generally classified as fixed, variable, or mixed. Firstly, let's look at fixed. Fixed costs are those that remain the same, regardless of the sales volumes. This will commonly include costs such as rent, utilities, registration and licensing, insurance, and often advertising and marketing. As a general rule, these costs remain unchanged regardless of if the business does $0 in sales, $10,000 in sales, or $100,000 in sales per week. Of course, there are likely to be minor changes if sales volumes increase substantially, but for the purpose of calculating contribution margin, break-evens, and profitability projections, these fixed costs will not change significantly between realistically variable sales volumes. So move on now, and we look at variable costs. This is the opposite of fixed costs. These are costs that change in relation to sales volumes. This will commonly include costs such as COGS, or cost of goods sold, franchise fees, where these franchise fees are charged as a percentage, as weekly franchise fees are in most franchises. Distribution and logistics, particularly if running a business that must be delivering, posting, or couriering goods out to customers on a regular basis. And third-party aggregated costs, such as the ones we've already discussed, like Uber Eats and DoorDash in food businesses or some retail businesses. In most cases, these variable costs are directly related to sales and as such are highly variable, which means if you get a sale, you incur the cost. If you don't get a sale, then you don't pay the cost. So I'll move on again. And then we look finally at mixed costs. Now, mixed costs are costs that have both a fixed and a variable component. A good example of a mixed cost is often labor. Now, labor has a fixed component, as I mentioned before. That is things like the salaries and wages that remain the same regardless of sales volumes. And then there's a variable component. Now, that might be those wages or salaries that change based on sales volumes, particularly the use of casual employees, contractors, sales-based bonuses and commissions, or extra hours and overtime. Too often, as I mentioned before, businesses incorrectly consider labor a variable cost. However, in most businesses, the majority of labor cost is actually a fixed cost, particularly in Australia, where it is both difficult and expensive for employers to change workforce arrangements. Regardless of what type of business you're running, there will be a minimum labor component required just to open and operate. This is the fixed labor cost component. For example, a restaurant may require a minimum of 2 people, as I mentioned before, one for the front of house and one for the back of house. A retail shop might require one salesperson at all times the store is open. A factory production line would require a minimum number of people to safely and correctly operate the production line at all times the production line is actually running. In Australia, in particular, where our labour market is highly regulated in favour of employees, businesses can often find it extremely hard and expensive to shed staff if things are getting tough. Full-time and part-time staff who have passed their probation period are very secure in their employment. If employers need to shed these staff, they have to pay out very large sums of money, and there are a lot of restrictions on how they can do it. And in fact, many businesses have gone bust simply because they couldn't afford to keep employing all their staff, but also couldn't afford to pay them out to leave either. Australian employers really only have the flexibility to scale back hours on staff who are in their probationary period or classed as casual instead of full-time or part-time. But the government is, of course, now trying to change this and make this harder to employ somebody as a casual. So essentially, if you are in this situation with a lot of full-time and part-time employees who are outside of their probation period, you may need to consider all of your full-time and part-time staff who are guaranteed employment each week and who are extremely expensive to get rid of as fixed costs. With all of this taken into consideration, the variable labor component is then usually much smaller and will slowly increase as volume increases. This will vary depending on the type of business and the type of employment arrangements you have in place, but will generally consist of some staff who are classed as casuals in Australia or contractors, or the overtime from full-time and part-time staff, and maybe some commissions or bonuses for certain people. The only real exception where the variable labor component might be more substantial than the fixed component is in very high volume businesses which have a heavily casual or contractor-based workforce and the ability to scale up and down quickly, potentially businesses that are very seasonal in nature. Once determined how mixed costs are made up, simply add the variable cost component in with the variable costs and the fixed cost component in with the fixed costs for performing calculations. So once costs are allocated, now we start to look at the different ways to use contribution margin effectively. So contribution margin is going to enable you to understand all of the following. Firstly, the amount of each sale, product or service that is required just to cover its variable costs and the residual amount that is left from that sale to contribute towards paying fixed costs or profit. This is especially important when working out if a product, deal, or promotion can be offered at a particular price. Secondly, the volume of products or services or sales that is required just to break even. Now, this is especially important when the business needs to figure out what it's aiming for. Without knowing what is necessary to break even, how could a business possibly set intelligent targets? Although it is actually scary how many businesses I have seen try. Third, contribution margin is going to enable you to understand the amount of profit or loss that can be expected at different volumes of products, services, or sales. Once again, this is essential for setting targets and goals. Nobody goes into business just to break even, although it is absolutely essential that you do. The goal is to make money, and it's highly beneficial to understand how much profit can be expected from different volumes. Additionally, from this, you can also work out the expected business valuation or how much the business is worth at different sales and profitability levels. But we won't go into it today. Now let's look at the calculations involved in working out actual contribution margin. So first we'll look at calculating contribution margin on products and services. This is where it may start to get a little bit harder for those that aren't watching via a video format. But I'll do my best to explain the formulas that are up on the screen for those who are following with audio only. So to work out contribution margin on a single product or service, we can look at this in either dollar terms or in percentage terms. Now, both are very useful and perform different functions. Now, first of all, if we want to look at contribution margin in dollar terms, now I've abbreviated contribution margin to CM for those that are following along on the screen. Contribution margin dollars equals the selling price per unit minus the variable costs per unit. Now, if we're going to look at it in percentage, so the contribution margin percentage equals the selling price per unit minus the variable cost per unit, exactly the same as we looked at for dollars, divided by the selling price per unit, and then multiply that answer by 100 to get a percentage. Now, once again, all figures are net, which means excluding GST. So let's put that into an example now. In this situation, we will pretend that you're a Mexican food franchise selling burritos, and you know the following information. Firstly, your sale price is $11. That's including a GST of $1. Or, once we take the GST out, that's $10, excluding GST. That $10 is the sale price that we need for this calculation. COGS, which is the product ingredients and packaging, is 25%, which is $2.50 excluding GST. Franchise and marketing fees, so we're going to assume this is part of a franchise, is 10% or $1 excluding GST. And labor is at the bare minimum necessary to operate the store, so is going to be considered a fixed cost, and there are no other variable costs to be considered. So just another reminder that all revenue and expenses are net, which is excluding GST. Do not include GST or any other type of consumption tax in these calculations unless you're in a country that specifically requires you to do so, which I'm not explicitly aware of any that are in this situation. However, let's move on. So our formula to calculate contribution margin dollars looks like this for those that are following on the screen. We covered this before, but contribution margin dollars is calculated and is equal to the selling price per unit minus the variable costs per unit. So in our current example, that means that our contribution margin dollars is equal to the customer price minus GST. So $11 minus $1 gives us $10. And then from that $10, you need to subtract the variable costs, which in this case was COGS and franchise and marketing fees. So that's $2.50 plus $1. So that once again is the selling price of $10 net, excluding GST, minus the variable costs, which add up to $3.50. That then gives us a contribution margin dollar amount of $6.50. So if we want to calculate our contribution margin percentage, that's going to look like this. Once again, the same formula we covered before for contribution margin percentage. Selling price per unit minus variable cost per unit divided by the selling price per unit, and then multiply that answer by 100 to get a percentage. So with our current Mexican burrito example, we're looking at a contribution margin percentage equaling the customer price minus the GST, so $11 minus $1, and then subtracting from that the variable expenses or variable costs of COGS and franchise and marketing fees, which is $2.50 plus $1. So we essentially have $10 as the net sale price minus $3.50 as the variable expenses, and then we're going to divide that once again by the net sale price of $10, and then multiply that by 100 to get a percentage. Now the percentage, of course, is 65%, which is fairly easy to work out in this circumstance because we've stuck to nice round numbers. Wouldn't be so easy if you were dealing with more complicated numbers, of course. So what does this calculation or these calculations mean? Firstly, it means that each burrito sold at this price does cover its own variable costs. Secondly, it tells us that $6.50 or 65% of every burrito sold at this price is left after covering its own variable costs, which then goes towards either fixed costs or profit. It tells us that every product sale with a positive contribution margin is going to be directly beneficial to the profitability of the business. Fourth, we know that the calculation can easily be adjusted to allow for common variations, such as different sale prices, different combinations of products, including bundle deals or packages, and additional variable costs, such as third-party aggregator costs, Uber Eats and DoorDash, for example. So now we'll look at where people go wrong calculating contribution margin. This is what I've commonly seen. You see people including fixed costs in the calculation as variable costs, such as fixed labor costs, rent, overheads, etc. Now, once again, for those following on the screen, on the right side, I've got that example from the Pittsburgh Post-Gazette as a classic example of including fixed costs as well as variable costs. Next common error is not removing GST from sales or costs before calculating. So once again, it's extremely important. Failing to remove GST or consumption taxes will distort the figures, especially where they are not applied consistently across all revenue and expenses. Third is forgetting some variable costs related to the product or service. It is important to really think through your variable costs through relating to products to ensure that all variable costs are captured in these calculations. Examples might include online transaction fees, particularly in networks where the vast majority of sales are online and there is a fee attached to most transactions. Third-party aggregator costs, as we've already spoken about, are also the other obvious variable costs relevant to food businesses such as Uber Eats and DoorDash. In many situations, you may need to calculate contribution margins for products when sold through different channels or at different prices, if this is applicable to your business model, to understand how this affects things within your business. Fourth is franchisors not including franchise fees based on sales, of course, as a percentage of sales, as most franchise fees are, into this equation. This is one that I've consistently found amusing amongst some franchisors that do actually calculate contribution margin on promotions and products they introduce for franchisees, which is sadly only a minority to begin with. Some will actually leave off their own franchise and marketing fees as a variable expense. The defense of these franchisors is often that they've worked it out based on their own corporate or company-owned stores, where they may not charge themselves fees, instead of franchise stores, or that they consider these fees to be a reinvestment back into the network and not actually an expense. All this is complete BS and a complete con job. Now, obviously, this is going to make contribution margin look better if you leave off any of your variable expenses, but it is incredibly deceptive as the expense is clearly a variable expense linked directly to a percentage of each sale in most franchises. And now we can go on and use contribution margin to calculate even more useful information, starting with a business break even. But before we use contribution margin to calculate break even, let's first be clear about what break even is. Break even point is where the sales or the revenue level of the business makes $0 profit and $0 loss. Break-even point is one of the most important figures for a business to consider during planning, as it clearly sets the sales benchmark the business needs to aim for as an absolute minimum to not lose money and start making money. And the break-even point can also be calculated as the number of items or customers or services that are needed, where the items, customers, and services are very similar or identical in nature. Now we can look at the maths of calculating break-even. So for those without access to video, I'll once again try and explain the numbers and the formulas as best as possible, but it may get a little bit tricky. So step one, to calculate break-even with a contribution margin. So use a profit and loss statement or a P&L or other reliable method to obtain the net sales. So that's exclusive of GST, and calculate all costs as either variable or fixed for a suitable period relevant to a typical business cycle, which may be weekly, monthly, quarterly, or yearly, depending on your business, ensuring that all costs are represented proportionately for that cycle period. Now, here is a highly simplified table to summarize the information in this example and ensure that costs are being classified as either fixed or variable. In this example, with the table on the screen, you'll see that the net sales are $20,000. So that's $20,000 excluding GST. Variable costs, we have two listed there. The first is COGS, which is $7,000. And the second is franchise and marketing fees, which is $2,000. We then have three fixed costs. The first being labor for $4,000, the second being rent for $3,000, and the third being other overheads, all grouped together for $3,000. We then continue on to step two, where we calculate the contribution margin. So the contribution margin percentage formula is simply net sales minus total variable costs divided by net sales, and then multiply that number by 100 to get a percentage. So with these numbers that we have available here in the table, we can see the contribution margin percentage will equal $20,000, which is the net sales, minus the two variable costs of $7,000 for COGS and $2,000 for franchise and marketing fees, and we then divide that by the $20,000 net sales and multiply that number by 100. So that's $20,000 in net sales minus a total of $9,000 in variable costs divided by $20,000 of net sales and then multiplied by 100. That gives us a contribution margin percentage of 55%. Now that tells us that 55% of our sales are left after deducting variable costs. Now this 55% once again goes towards paying fixed costs and towards profit. But what we want to work out here is the business break even. So we go to step three. It says after calculating the contribution margin percentage, the formula to calculate break even looks like this. Now, on the screen, if you're watching, you will see that I've abbreviated break even to just BE. So to work out our break even dollars, we need to do the total fixed costs divided by the contribution margin percentage, which we just worked out. So with the numbers in this example, we have $10,000 of fixed costs, and we have a contribution margin percentage of 55%. So $10,000 of fixed costs for labor, rent, and overheads, divided by the 55% contribution margin, gives us a break even of $18,182. So what have we worked out here? We've worked out that in order to cover the fixed costs of $10,000 per week, which we're going to have to pay regardless of the sales, when there is 55% left after paying the variable costs, which keep in mind this 55% is a contribution margin we've been talking about, we will need $18,182 in sales per week to break even. Once again, we're always talking in net costs, excluding GST. Now, if the contribution margin was larger, the break even would be lower. If the contribution margin was smaller, the break even would be higher. Likewise, if the fixed costs were lower, the break even would be lower. And if the fixed costs were higher, the break even would be higher. So now let's look at using contribution margin to calculate a break even when there isn't any current detailed information available, such as would be the case before opening a business. So, to calculate break even using a contribution margin with anticipated costs instead of actual costs. For planning purposes, such as prior to opening a business, for example, before actual sales and costs are known, the break-even calculation can still be performed using industry average variable cost percentages and known or expected fixed costs. In simple terms, if you are going to open or buy a business, and especially if it is a franchise business, you will almost always be able to get some average aggregated data from the franchisor or at least the industry. This will tell you what percentage of sales usually go towards different expenses, especially variable expenses. Then you should be able to get a fairly good understanding of what your most significant fixed expenses will be from different sources. For example, you will know that your rent will be a certain cost because it will be in your lease. You will be able to calculate what your minimum fixed labor costs will be necessary to keep the business open. You will know what your insurance, your work cover, your licenses, your registrations, and your subscriptions, etc. will be. And you will be able to get a fairly good indication of what you will pay on other overheads, such as electricity, gas, and other utilities, especially if joining a franchise, as other very similar businesses within that franchise will know what they are already paying. So now, for those without video, we are looking at a sample of projected expenses. Note that we don't even need revenue or sales projections to do this calculation for break even, just expenses. The summary of expenses that I've just put up on the screen for those watching on video is variable expenses with COGS at 35% and franchise and marketing fees at 10%. We then have fixed costs of $4,000 for labor, $3,000 for rent, and $3,000 for other overheads. So variable expenses are expected to be a total of 45% of revenue or sales. Fixed or overhead expenses are expected to be a total of $10,000. Now, our formula to work out break even with just this information is total fixed costs in dollars divided by the contribution margin percent. So that's break even equals total fixed costs divided by contribution margin percent. Now, to insert the figures that we've got in the table, your total fixed costs include the $4,000 for labour, $3,000 for rent, and $3,000 for other overheads. Your contribution margin is calculated simply by taking 100% and deducting your variable costs, which are 45%. This then gives you a fairly simple calculation of $10,000 of fixed expenses divided by 55%. And that results in a break even of $18,182. So now that we know the break even, let's look at how we can work out expected profitability at different sales volumes. If you want to calculate your anticipated profitability at any sales level with contribution margin, this method will work at any sales level you choose. But for this example, we are going to work out the profitability of $20,000 in net sales, just to keep things nice and round and simple. To work out expected or anticipated profitability at $20,000, we will use the same anticipated expenses that we used in the previous example. That is, net sales of $20,000 ex GST, as I already said, variable expenses of COGS at 35%, and franchise and marketing fees at 10%, and fixed expenses or costs of labor at $4,000, rent at $3,000, and other overheads at $3,000, all up on the screen if you're watching along. So we are expecting a total of 45% of sales to be consumed by variable expenses in this example, which is purely COGS and franchise and marketing fees, and $10,000 of fixed expenses, which is labor, rent, and other overheads. Now we need to work out contribution margin dollars, which, as previously covered, simply means deducting the variable expenses from the expected sales. In this case, we expect the variable costs or expenses to be 45%, which means the contribution margin dollars will be 55%, which is $11,000, which, as you hopefully remember, is the amount that we now have to cover the fixed expenses. Then it's just a matter of deducting the fixed expenses from the contribution margin dollars. Now, that is stepped out on the screen as follows. So, profit, once again, equals contribution margin dollars minus total fixed costs, which in this example means $20,000 times 55% to give us our contribution margin dollars minus $10,000 of fixed costs, which, to summarize that a little bit further, means $11,000 minus $10,000 and gives us a profit of $1,000. So that means at this sales level of $20,000, we have a profit of $1,000. Now, as mentioned, you can easily substitute the $20,000 expected sales for any figure you like and can get projected profits at a whole different range of sales volumes if you want to. Then you will know what you are aiming for. If you have $20,000 in sales, or $22,000 in sales, or $25,000 in sales, or $30,000 in sales, you can utilize this formula with any set of numbers you like. Alternatively, maybe you would like to work out how many things you would need to sell in order to break even, rather than just a sales figure. So contribution margin will be able to help you out here as well. Okay, so to use contribution margin to calculate the number of units required to be sold to break even. This is most useful where a business produces or sells a high number of similar or identical products or has a limited range, such as in simple manufacturing or retail operations. So once again, let's look at a fairly simple example. So the example here is a retailer selling fidget toys at their kiosk in the mall. each fidget toy sells for $3 excluding GST and costs $1 excluding GST to buy from the wholesaler. So that's your cost of goods sold, which is 33%. The kiosk has overheads totaling $13,000 a week excluding GST. So I'll put up the table for those watching on the video that summarizes this information. So once again, you've got variable costs of 33%. You've got labor of $4,000 per week, rent of $5,000 per week, utilities of $2,000 per week, and other overheads of $2,000 per week. So let's go to step one. Step one is to calculate the contribution margin dollars for each unit or product. So that's a fairly easy calculation, but we'll still put it up on the screen here. Just a reminder that the contribution margin formula for dollars is the selling price per unit, which we know is $3, minus the variable cost per unit, which we know is $1. So the formula is as simple as that. For contribution margin dollars per unit, we're looking at $3 minus $1, which is obviously $2. Once again, a reminder, all figures are net, excluding GST. Step two is to divide the fixed costs by the contribution margin dollars per unit. So once again, I've abbreviated break even to BE. So to work out our break even units, we need to take the fixed costs and divide them by the contribution margin dollars per unit. Now we know that our fixed costs from the table on the side are $4,000 for labor, plus $5,000 for rent, plus $2,000 for utilities, plus $2,000 for other overheads. And we know that our contribution margin dollars per unit is $2. So to simplify that formula, we are taking $13,000 of fixed costs and dividing them by $2. That then tells us that we need to sell 6,500 of these units or these fidget toys to break even. 6,500 is what we need to sell. Now, I certainly appreciate that all of those formulas is a fair bit to take in, especially if you've been trying to follow along in an audio-only format. If that's the case, I would strongly recommend that you watch the video, which is available either on Spotify or YouTube. Otherwise, if you want an even easier solution and a way to incorporate contribution margin into your business, we've got a free calculator available. This is a spreadsheet you can download for free from fmssupportservices.com.au. And it incorporates contribution margin to help you calculate both break-even and profitability projections at various sales levels. So I've just opened up the spreadsheet there to give a quick explanation of what is included on it, but I will keep this section fairly brief as it will make pretty much no sense at all if you are not watching on a video format. When looking at the spreadsheet, the first column is in between the red lines there is purely to calculate break even. The next 5 columns, option 1, 2, 3, 4, 5, as named across the top, are to help you calculate profitability at different levels. All you need to do is enter the maroon cells either as a dollar value for fixed expenses or as a percentage for variable expenses. If you look at the column, you will see which one is required, either a percentage or a dollar value, and depending on what you enter, the other one will automatically be calculated for you. For the sake of speed, I've pre-entered some data into the maroon cells here. The green and yellow cells will then calculate automatically. Now the different sections are broken down as follows to vaguely resemble a very simple profit and loss statement. Up the top, you've got the net sales, remembering that everything must be excluding GST. For the sake of this spreadsheet, sales is actually broken down by the number of transactions and the average transaction value. The reason for this is to help reinforce the dynamics of growing sales either through increasing transactions or increasing the amount of money made per transaction. This is the ultimate balancing act of generating sales, but that's a discussion for another day. Then the next section down is cost of goods sold, which is to be entered as a percentage of net sales because this is a variable cost. In this case, for this example on the spreadsheet, we are saying that it's 30%. Under labor, which is the next section there, for the break-even calculation, we've just entered a bare minimum fixed cost to keep the business operating for break-even. For higher level sales projections in the following columns, we have also added a small, slowly increasing variable labor component. Then, assuming this business is a franchise business, we've allowed for franchise fees, both franchise and marketing fees. Then under operating costs, we have a whole range of different costs. Obviously, it's not possible to have every cost for every type of business listed, but if some of yours aren't listed, then either enter in the closest possible category or the miscellaneous category at the very bottom. All are entered as a dollar value, being that these are fixed expenses. This then gives you, a bit further down in the darker yellow cells, an EBITDA result. So EBITDA stands for earnings before income tax, depreciation, and amortization, which is basically operating profit before accountants get involved. Then there are some additional payments that come after EBITDA, which aren't technically treated as expenses from an accounting perspective, but need to be considered as they represent money that the business needs to pay for things, such as the owner's drawings or the amount of money that the owner pulls out each week, plant and equipment repayments, and loan repayments. In this section, we simply entered a fixed cost of $1,000 per week for a loan repayment, just to keep things simple. Many franchisors, in particular, like to conveniently forget about these payments and just look at EBITDA, so they can comfort themselves that franchisees are making a lot of money. However, the reality is that if you have an EBITDA of $1,000 per week, but are then having to make $1,000 in loan repayments per week, then you have nothing left. So that is why we factor these into our break-even calculation on this spreadsheet, so you can understand how much you really need to break even from a cash flow perspective each week, but also from an EBITDA perspective, if that's what you're concerned with as well. Both are very important. So from the break-even calculation, the first column, we can see that we need exactly $12,642 to break even, or in this case, 421 transactions at an average of $30 each. Then we can look at the next 5 columns. We have kept the fixed costs the same, added a small variable labor component in the labor section to allow for small increases in labor, and then just up the transaction numbers so that we can look at profitability and cash flow in the yellow cells at different levels. What we can see from this spreadsheet with just a few figures inputted into it is that at $15,000, you would have $965 in your pocket each week. At $18,000 in sales, you would have $2,495 in your pocket each week. At $21,000 sales, you'll have $3,965 in your pocket at the end of every week. At $24,000, you'll have $5,375 in your pocket at the end of every week. And at $27,000 in sales, you will have $6,725 in your pocket at the end of every week. Now, the best way to really get an understanding of this calculator is to download it, which is, of course, free and available at the fmssupportservices.com.au website, and have a play. Try running your current business numbers through, work out a break even, and then look at what your sales goals look like from a profitability and cash flow perspective. Obviously, You use this at your own risk, and myself and FMS Support Services won't be held responsible for any data corruptions, errors, and especially for any changes that you make. However, there are quite a few franchise networks that use this or a variation of this, so that would indicate that it is a pretty good place to start. And please keep in mind that the data that comes out of it is only as good as the data you put into it. So making sure that the figures you input are as accurate as possible is going to be to your own benefit. Lastly, before we move on, please remember that the calculator's results are indicative only, and always discuss your break-even and profitability with your accountant or other qualified professional. And that then brings us towards the end of today's presentation. Hopefully this topic of contribution margin has been useful. Using it to understand your profitability and break even in particular on products and the business as a whole are its most important functions. And if you currently just guess these numbers, then I would suggest you make utilizing it a priority. When people do, they often find their numbers are very different to what they think they are. Please don't feel bad if some parts of this presentation didn't make sense at first. Unfortunately, this isn't covered as much as it should be. If you are listening on audio and have struggled to make sense of it, I would definitely suggest watching the video format so you can see the formulas and the numbers as the calculations are worked through. That will help it make a lot more sense. And then try rerunning the formulas with your own numbers. Or if you just want to take the easy route, download the calculator from fmssupportservices.com.au. If you have any questions, please feel free to email us at info@fmssupportservices.com.au for a personalised, confidential, and definitely free response. Otherwise, if the option is available at the point of download, feel free to leave any comments or your questions in the comments section or on Facebook or LinkedIn, where you may have found this link, and I will get back to you as soon as possible. Remember, you can follow us on Facebook, LinkedIn, YouTube, Spotify, or wherever you download your podcasts. There are plenty more presentations and other things coming up. If you have any suggestions or requests for topics, please let us know and we will add them to the growing list. If you found this useful, please leave us a positive review and a 5-star rating, as it will assist the algorithms in sharing it with other people that may also find it useful. Otherwise, if you know anybody that may benefit directly, please feel free to share the link directly. Your support is appreciated. Thank you.